Good morning, everybody. Thank you for joining us virtually.
So hopefully you can now all see some stormy skies or sunset skies and a sea. James and I will take you through this. The sort of rules of the game. We would love to get some questions both at the halfway point and then again at the end. If you'd like to ask a question, if you use the chat facility, that would be fantastic. And while I'm talking, James will just look at the questions and we'll have a pause, and then the two of us will answer them. And then when James does the second part, I will be looking at the questions coming through the chat room. And again, we'll answer them at the end of James' section before we sign off. I think given the number of people on the call today, we decided it was probably just too hard to do a sort of waving of hands live question.
The only other thing to mention is just that we are recording this, and the intention is that it'll be posted up on our website. We just legally have to tell you that that's actually going to happen.
Thank you. So I thought we'd just start off with a reminder that bear markets happen. And just to go through the shape of some of the previous bear markets before we put this one in the context. If I look at whole decades before I look at individual bear markets, there is just a very long run pattern of fantastic decades and really quite appalling decades. The very good decades like the 80s typically follow off the back of a very poor decade like the 1970s. But anybody who has studied long-term returns will know that the path to making money is littered with traps and falls and bear markets, but we always seem to find a way to muddle through in the end. And by the end of the last decade, we were already projecting really quite a low, unattractive return over the decade ahead, having come off the back of a really quite good decade in the 2010s. So what is it that is really driving the volatility in a multi-asset portfolio? Well, it's the equity market effectively. I've just listed here some of the worst bear markets we've seen, 16 of them in the last 50 years, an average fall of 30%, typically taking about a year to get from top to bottom, which is why arguably the one that leaves some of the worst scars for us is the 2000 to 2003 one, because that was a near 3-year bear market. Equally, what went on in the 70s, 72 to 74, was an elongated bear market. And just to touch on the bear markets prior to the last 50 years, of course, the two really big ones were the late 20s, early 30s. We lost 40% in the UK equity market and 60% in the US. And then again, actually in the run up to the Second World War, both the US and the UK losing about 50%. To put all that in context, at the worst point this year, UK equities were off by about a third and overseas equities by just under a quarter. And that's just the numbers charted. And it draws out quite nicely that one of the different things about this particular bear market was the speed and pace of the decline. We managed to go from peak to trough in about 4 weeks, with regular daily moves of -5%, -10%, then up 5%, then down another 10%. It was quite extraordinary volatility, but the speed with which we reached the loss was unprecedented. Now, I just wanted to remind everybody that whilst we've kicked off with equities, it's not always about equities, and it's very easy to fight the last battle or the last bear market we remember. But just pointing out, because this may well pass in the life of trustees working and executives working today, but there have been numerous occasions where you've lost an awful lot of money in gilts. Between 1947 and 1952, 25% in absolute terms over 6 years, but 52%. You lost half your money in real terms. Ditto in the 1970s, a -20 between 72 and 74. But again, more than half your money lost in real terms. So there are times when even the most defensive asset class can give you a great deal of pain. And probably the suffering is greater because this is the asset class that you do not expect to hurt you in your portfolio. But gilts can hurt you. We know that corporate bonds can hurt you. And in fact, this was a market that a lot of people were expecting to give us the last really ugly surprise. Because of course in 08, 09, it was the one that shocked people to the core. And I've just charted here the price of a Barclays Bank bond. And of course, Barclays was one of the banks that managed to get away with less or no public funding of such, but much less funding than others. So this was a good case. And the Barclays bond fell from 120p down to 30p before redeeming at par. So corporate bonds can give you a great deal of pain. Hedge funds too. Just a reminder that, you know, even the places where people tend to think they will see uncorrelated returns, particularly more recently, have not been that helpful. You know, they were a spectacular place to hide in the two wobbles in the 90s, ditto in the sort of 2000, 2001, dot-com crisis, they held on to value. But in 08, they performed really very badly indeed, with a sort of 21% loss, and 11 and 18. And again, we're projecting that most hedge funds will have fallen in value in 2020. If not by as much as the equity market. Again, you know, a rude awakening for people who thought that was a truly absolute return part of their portfolio. Gold, again, just a reminder that gold can be seriously damaging to your wealth. You know, an 80% loss between the mid-80s and the mid-90s before a really dramatic recovery. But then again, another opportunity to lose 40% of your money very quickly in 2011, 12, 13. So basically, all asset classes can hurt you, but are balanced out by the reciprocal bull phases. And this chart actually goes on for much longer, because bull markets tend to be bigger and longer than their bear market siblings. The red line here shows you the bull market that came to an end this February. So we're in a really extended bull run, both in magnitude and scale. So whereas the average bear market is a 30% correction over 18 months or so, the average bull market is a 3 timesing your money over a decade. So just to put that, or the bear markets in context. Now, of course, most charities, most investors don't own a single asset class, they own diversified portfolios. So what we should really look at is not the peak to trough falls in a single asset class, but what it looks like when you've blended it all together. So those who read our compendium will know that we have traced endowment fund returns back to about 1900, blending the asset classes together in the way that we think would have been most suitable at the time, embracing new asset classes as they came along. The big recent change for most UK charities will have been diluting their UK equities and moving more and more money overseas, which has definitively helped both in 08-09 and again in 2020. So if we model how these portfolios will have performed, so this is peak to trough to the time it takes to get recovery, and I put the current bear market in red. My charting skills were severely tested because the pace of the decline and subsequent recovery has been so great. That is the thing that really differentiates this bear market from others that preceded it. You know, I think we saw multi-asset funds, our endowments fund, but most multi-asset portfolios will have been touching high teen, not probably quite 20% negative returns after 4 weeks into the sort of the second week of March when we reached maximum pain. But the recovery since then has been such that most of our portfolios are now showing a negative return for the calendar year 2020 to close the play last night of between -6 and -10%. So in that context, this bear market is almost the bear market that was over before it began when you compare it to previous bear markets and their impact on endowment funds. Now, I think we're going to have a long conversation in James's part as to whether this really is the end of it or whether we've got a second leg down to come. Because when you look at the damage we've actually done to the economy, and I've just been modeling what might happen to dividends, what might happen to profits, the shape of the world economy. What I've drawn in here, I've taken an endowment fund back to 2012. So the solid grey line at the beginning is simply how an endowment fund would have performed between 2012 and the peak of the market in early 2020. The dotted red line is CPI plus 4%, which is the sort of, I think, a reasonable long run target to level of return to target. And then the black line is what we have actually suffered. So there's the sort of near 20% decline and the recovery to back to a sort of -6, -7%. The orange line is what I'm terming the classic bear, where markets reflect the collapse in profits. There is an element of re-rating, so the yield goes up, PEs go down, and then a recovery. The blue line is what I'm terming the muted bear market, where authorities move in very rapidly to stop the decline. And the green line is actually just reflecting the actual damage we probably are doing to the economy, where you get a leg down and then you get a second leg down when the markets aren't as cheap as they appear to be after a 20% fall, because you see a 20 to 30% cut in profit and dividend forecasts for the next 2 or 3 years. So the market then marks itself down again to a level at which it then appears cheap and then it recovers. And if I was drawing the shape of this bear market purely using fundamentals, I'd probably be looking at the green line. However, the speed and pace of the central bank reaction has actually caused markets to look like the black line. And the big question we will have to ask ourselves in the second part is, can this disconnect between markets and economic reality continue? Can governments, reserve banks, and the authorities really manage markets in such a way that what they're trying to do is not turn a drama into a crisis, not turn a big economic recession into an even worse one by having a prolonged rout in asset markets and much lower asset values that would cause even worse economic consequences? They are going to try and stop that from happening and try and maintain asset prices more or less where they are today. But whether they can do that, I'm going to wait for James to tell us all in the second part. So that's really a history of bear markets, and this one in the context. I just wanted to say a few other things about what we think you should do to mitigate the impact of bear markets, of which the singular most important one is the primary mitigation, what you need to do before a bear market strikes, or if you get an opportunity part way through a bear market to ensure that your ship is in order. So the first of these is simply education. Just ensuring those initial slides I've shown are known by everybody who's on the investments committee, the wider trustee board, the executive, even fundraisers, that there will be some very dramatic bear markets along the way. They will probably take virtually everybody by surprise. In fact, you have to take everybody by surprise. People have to be unprepared to see the collapse and the panic and the fall in asset prices. And as a result, therefore, cash flow, asset and liability modeling is mission critical. You only invest in equities and other volatile asset classes and the more liquid asset classes like private equity and property if you are going to be able to ride out a bear market without touching the investments and thus realizing the loss at the bottom at an inopportune moment. It's mission critical never to be a forced seller of volatile or liquid assets at the wrong point in time. Asset diversification, that's one that actually often gets away from people, that when you've had a bull market going for 5, 7, 8, 9, 10 years, it's terribly easy to try to keep up with the Joneses by selling your gilts down. We know there are fund managers out there who ended up by the end of 19 owning no gilts. The reason being, the total returns, the projected 10-year government bond yields look deeply unattractive. I think that just fails to recognize that in virtually all sudden bear markets, it surprises gilts are the place where you can hide. And even if technically speaking, a gross redemption yield of 0.8 is not attractive, plus 0.8 is a great deal better than -20 or -30. And that's what asset diversification is all about, trying to provide a smoother return through good and bad. And also, of course, security diversification. We've seen individual securities fall by 60, 70, 80% in this bear market. There will always be some companies who fail to get to the other side of the bear market. And the point of diversification is to ensure that you don't have one or two companies that have a inappropriate or far too greater effect on your overall return. So we are great believers in diversification through the cycle, both at the asset and the stock level. So that I think is pre-bear market activity. Secondary actions to be taken during a crisis. There are things you can do, both that we, your fund manager, can do and you yourselves can do. And the first is just to go over the cash flow and the projections. Now, each bear market is different. the way that governments and regulators react is different. The way your charity or company or personal finances will be affected will be different. And you won't know how different until you know what it is that has caused the crisis. So most of the team at Saracen and Partners are trustees on their own right and are working with charities. And I know, in addition to talking to our clients, we've been looking at the operations of the various things we work for. And we're seeing some very differentiated impacts between museums and schools, who are clearly suffering from the white heat of this particular crisis, through to charities who've actually been relatively little impacted. So again, doing the necessary work to see whether you are going to need to dip into your investments to perhaps supplement income that now won't be coming in worthwhile. Dialogue and discussion, again, that's all part of just managing the process. We do typically find a way to muddle through. You know, the capitalist economic system has found an extraordinary way to get to the other side of even deep and unforeseen crises. And it's just worth reminding ourselves of the history that we have been here before. You know, I was 50 years old this year. There have been 16 severe bear markets since I was born, an average of -30, including one that was a -70 and one that was a -50. And I think if I'm living like Captain Tom in 50 years' time, when I turn 100, I will take a £10 bet that will be at least 16 bear markets between now and when I turn 100. The average will also be -30, and they will all come and surprise people and the next generation of fund managers and trustees alike. So I just think the dialogue and discussion is critical at times like this, so that we don't make any panicked or inappropriate moves. And then the last one is active management. And again, James will probably touch on this, but again, because we, like other fund managers, were surprised by the particular nature and spark for this bear market, the first thing we do is we just go through our entire portfolio, stress testing every single security we own. So the bond team go off and go through every corporate bond that we hold. The equity team, they go away. Our morning meetings for the past month have been 4 or 5 companies every single day, where the analyst is coming back, having revisited all his spreadsheets, his bottom-up projections, probably having spoken to the management team, looking at companies that have reported that we might not own, but whose results will reflect on the ones that we do, and basically asking ourselves, if these were the right companies to have held over the previous couple of years, have things changed such that we actually now need to actively manage the portfolio and move away from them? Has something, you know, have they either performed extraordinarily well, in which case they might now be looking very expensive, or has the game changed for them? Is their business model, if not broken, severely damaged enough? And whilst our thematic approach tends to really link us to long-term growth stories and has fared pretty well, particularly in this bear market, it behooves us just to, as I say, stress test every holding in the portfolio. So we've looked at all the infrastructure funds we own in the alternatives, to make sure that whatever we've done on the way down, it's not about yesterday's performance. We have to wake up every morning trying to perform well into the future. So that's what we're doing on your behalf. And then finally, just, I tend to think that in the same way that the biggest errors are made before the bear market ever happens, there's not a huge amount you can do while a bear market is going on. But actually the other greatest errors and the setup for the best performance going forward, they're actually made after the bear market or at the tail end of a bear market, where it is very easy to make decisions based on how somebody has recently performed. This is a whole chapter in the compendium about style bias between different fund managers. But there are definitively managers out there who are perma bulls and others are perma bears. And these leopards tend not to change their spots. And you will have managers who tend to do well in a rising market and at the top of the pack, and others who tend to do very well in bear markets. And of course, what you really want to do is buy the bearish manager at the top of the bull market and buy the bullish manager at the bottom of the bear market. But actually, when you look at fund flows, what typically happens is the target and absolute return managers win a huge amount of money in the year after a bear market, at the point at which their returns will probably go sideways. And equally, the ones who have just suffered, who may well be about to rebound, lose the money at the top. So if you have a manager who has a strong style bias, not all do. You know, I would put ourselves in probably the I think we're definitely in the glass half full camp, but we're not in the glass overflowing camp. You know, there are a lot of managers out there who went into this bear market with 80% in equities. But equally, you know, I'd be honest, our core endowments approach is probably glass half full. Whereas there are definitely approaches out there that don't view the world as anything other than ever half empty. So I think just thinking and understanding and really knowing why your managers perform the way they have, and then however they performed, it's all about how they're going to perform in the next 5 years or the next 3 years, not the last 5 or 10. So we see this changing of horses mid-race can be really very damaging to your long-term wealth. And of course, the final bit where I want to draw to a conclusion is managing the aftermath part 2, which is really ending where I started, which is the best defense against the next bear market is to go back to the first slide and just ensure that you will never have to withdraw from markets completely, that you're not going to get spooked out at the bottom, that you've put a lot of thought into your cash flow requirements over the next 2, 3, 4 years to ensure that you have an asset mix in place, quite possibly split between different portfolios, because you will have enough cash to withstand and to be able to not have to sell volatile assets at a really inopportune moment. And I was really going to conclude, therefore, that we reckon that a modern multi-asset, overseas-dominated portfolio, probably even after the correction we've seen, has produced a return of about 7% per annum over the last decade, culminating in that plus 20 last year. And therefore, with the recovery we've now seen, we're looking at a portfolio that's off maybe 6, 7, 8% calendar 2020 off the back of a very, very good decade. If this bear market has done significant damage to your income generating abilities, or simply if you feel this is the moment when you need to put your hand in your pocket and your charity needs to support the system and be benevolent right now, now is far from too late to sell. In fact, now in the grand scheme of things is still a relatively high level of asset prices. So if you need to supplement, or you think you're going to need to supplement your income with some additional monies over the next 2 or 3 years, from a strategic perspective, I think we'd all be taking a little bit of money off the table right now. Now, at that point, I'm going to open it up to some questions before we turn to the tactics of exactly what is going on at the moment and what we're going to be doing in portfolios over the next few months. So I'm going to pause there and turn to James.
Hi, Richard. Well, actually, Dominic had just asked a question that you just answered, which is whether the current rebound is an opportunity to raise assets if needed. And I think you've answered that. I think that then but it also comes down to each charity's individual situation. And if there is still there's obviously clearly a lot of uncertainty, but if you feel that you need to raise some assets from the portfolio just in case things deteriorate further, then now probably wouldn't be a bad opportunity at all. We never quite know what's going to happen over the next 3 to 6 months, but I'll try and give you our views in the coming minutes. There were a couple of other questions. One was on interest rates and turnover. I thought we might tackle those after I've gone through my slides, and Richard might want to comment particularly on the turnover on the endowment funds towards the end. But on that note, unless there was anything you thought that you'd raised, Richard, I would.
No, I'm just looking at the questions, and I think an awful lot of them will be, at least in part, answered by what you're going to say. I'm just scanning if there are any that we can do quickly. Simon Jennings, what equity weightings do you tend to have for the endowment funds before and what now? We were just under 70 when we went into the crisis, and we allowed that, and through our own actions, to get to about 64, 65, probably 64 because we had a bit of portfolio insurance in place. Right now, today, we are a fraction underweight, so we're just under 70% in the core endowment funds. And James, as you see, I think most of those questions you're either going to tackle or I answered at the very end. So if everybody's happy, James, I think we'll turn to you and you can do your shared screen and we'll listen to you.
Great. Can you see that, Richard?
Yeah, that looks good. Number 4, global strategy and outlook.
Great. Okay. So following Richard's sort of compendium-ish type talk, I thought the first thing I'd just talk a little bit is about what's gone on in our portfolios, what's influenced performance. And this is a slide that a lot of us are using in front of you as clients if we're having virtual meetings. And whilst we hadn't predicted the crisis, there are some things that the pre-positioning that had helped performance. And as Richard alluded to, we were sort of mildly underweight equities in our equity allocation within our main multi-asset funds as we came in. But I think also importantly, the thematic stock selection had been reasonable in ensuring that we were avoiding some of the worst hit areas. So we listed there airlines, restaurants, a lot of retail exposure and so on. But also there on the energy sector, you'll no doubt be aware that we have climate change as one of our core themes at the moment, and that has led us to be quite out of energy companies across the business, particularly those in the climate active fund, but also in the main endowments fund, where we now only hold a very small position in BP, and actually sold Shell earlier in March, and it was interesting to see that they cut their dividend for the first time in a very long time this week. But I'll come on to dividends a little bit later. The defensive assets, the fact that we still held gilts that were up 6 to 8%, I think, in the first quarter was beneficial, as was the allocations to both gold and the absolute return fund that we have, the MB uncorrelated, which both produce positive returns. I think we'd probably been given quite a hard time about holding some of the government bonds, given the lower prospective returns in the future. But as Rich has already alluded to, they did bail us out in the first quarter. And also there was a little bit of portfolio insurance put in our multi-asset funds. And that is where we've bought some insurance because we felt that markets were quite up with events, and it was quite cheap towards the second half of last year to buy that insurance. Richard's talked a lot about what we've then been doing, and that's the stress testing already. So I'm not going to dwell on this too much, but just to, somebody asked already, but we will send these slides out so you can see some of the important work that the analysts have been building up based on our economist Sabitha and Nilofer's expectations of economic growth, and how that's going to impact each individual holding within our portfolios. And I've just highlighted that 0.7 there, which is, what we're trying to avoid here is that risk of permanent loss of capital, because that's the worst thing that you can have during this particular period. So if that's a little bit about how performance has been affected and the stress testing, I thought now I will just move on a little bit about the financial markets and economic conditions first. I'm sorry that we have to start with this chart, but there really isn't anything else that matters at the moment, and that is the tracking of the COVID crisis. And, for the first time, probably this last week or two, the flattening of cases across Europe and also in America is starting to give some sense that there might be some light towards the end of the tunnel in terms of being able to get out of lockdown. We just highlighted there that the UK measure is now at the highest within Europe, but also, Guy's alluding to when he's been doing his talks about how the path is more about following Asia now as we're getting to that mitigation point. The only thing I'd add about Asia is that they would have been better prepared for this pandemic than we have in Western Europe and America, largely because of their experience of dealing with other viruses, whether it's bird flu, SARS, etc., that has enabled them to be better prepared. And I think that's why you've seen better trajectories from them. But ultimately, what has that meant for our projections for economic growth? Now, I wrote in our investment outlook that we had a base case and a range as to what we thought global GDP would fall by. and that was around 3.2% in terms of the midpoint of that range. And you can see here that the latest work that we've been able to do has meant that we've downgraded the base case for the negative dollar growth for global GDP to minus 5.8%. So that is a hugely big, as you can see on the chart on the right-hand side there, that is hugely a huge contraction in economic activity, multiples of the size that we saw during the financial crisis. So really underpinning that, you know, we're in a particularly difficult time. And we'll come on to this again, because ultimately I think we're quite surprised, as Richard's already shown, how quickly markets have rebounded. And this is also starting to come out in the data on the ground here. So what I'm showing you here on the left-hand side is the PMIs. So these are the Purchasing Managers Indices for both the UK and Europe. And they are the sentiment index. And any measure below 50, and you're more pessimistic about tomorrow than you are about today. And unsurprisingly, you can see these extraordinarily low figures that have come out from the Euro area and the UK, down in the low teens there, way below anything that we got in the financial crisis again. So just underpinning the size of the particular shock that's going on at the moment. And then in America on the right-hand side, what we're tracking here is the unemployment figures. You know, a lot more people being made unemployed quite quickly. So these are the jobless claims that have been going on. And pre-corona, we had in America, there were 5.8 million people who were unemployed. And then you can see week by week, as this situation goes, there's more and more people that are unemployed, such that now there's nearly 20% unemployment in America. Now, that's a pretty dire situation. And the central banks and the governments around the world, of course, are completely aware of that. So to offset that economic contraction, we've had some extraordinary fiscal and monetary packages that have been announced, particularly led by America up here, where we think that the total of the fiscal and monetary package is going to be about 12.6% of GDP. That's a huge stimulus that's coming through. China, slightly less so. They've had a slightly more controlled version of the crisis. Just noting here that the EU budget at the moment is struggling to get going. And I know when Guy Munson, our Chief Investment Officer, he often highlights this as a particular risk at the moment. And I've got a chart on that in a second, but only 0.3%. So we're still looking for the EU budget to be allowed to be spending more money to try and mitigate some of these risks. But Japan and the UK are also doing the same thing. So what does that mean? What does that look like for the UK? So what I'm showing you here is the net borrowing of the UK. And this is straight from the Office of Budget Responsibility here. And you can see that they're estimating that on the right-hand side, this year, we're going to have a budget deficit of about 14, close to 15%. So 273 billion. And that's, you can see in the context of what we were doing during the wars in the early 20th century. Now, that's probably going to take us to a debt to GDP ratio of about 100%, which sounds quite a lot, but actually after World War II, our debt to GDP reached 250%. Now, clearly, we don't want to get back there if we can help it, but there is some scope, I think, for the government to spend a little bit more if we need to. The only thing I'd add on here is that we think that these figures are probably a little bit optimistic in terms of some of the assumptions that they're making as to how quickly we're going to get to return to work. And as I mentioned, perhaps the two key things that we're monitoring, and I know Guy's monitoring in particular, are inflation expectations and Italian borrowing costs. And that's shown on this chart. So on the left-hand side here, we have the US expected inflation rate 5 years from now. And you can see initially when the crisis happened that inflation expectations as derived from the markets plummeted to below 1%. And now there's been a recovery up to 1.5%. And I saw that one of the questions was about if you're worried about inflation and you don't want to own bonds, where do you go? And perhaps we'll come to that at the end. But I think at the moment, this is telling you that markets are not worrying about inflation. And this is a deflationary shock. When you've got a supply and demand shock as we've had, actually these forces are very deflationary. So the fact that the central banks have come and underpinned markets has helped mitigate some of those deflationary risks. And then closer to home here on the right-hand side is Italy. And we know their precarious budgetary position. And we're just watching closely here the premium that markets are putting on for Italy to borrow money relative to Germany. So at the moment, it's costing Italy an extra 2.2% to borrow money over and above Germany. And I suppose this might be the canary in the coal mine for the euro area. You know, this is why they need to expand their budget to try and support these the peripheral European countries and those with worse economics than the northern countries. So if that's the sort of a brief tour, because I'm conscious of time, of the economic conditions, what about the financial market implications? So this chart here just plots what's happened so far this year from 4 major asset classes and their returns in sterling. So you can see at the top in yellow here that we have gold. It's done very well, that safe haven asset, but also helped by the fact that we've had a slight weakness in sterling over the period. We've had government bonds. Again, that safe haven quality did come to the fore. And I think I wrote in our investment outlook that the quarterly difference in returns from government bonds and UK equities was nearly 30% over a 3-month period. That's quite an extraordinary difference in returns. And then below, we've got world equities and UK equities. World equities doing slightly better than the UK version. Some of that is because of the makeup of the UK stock market, but also because the world equities have the US stock market in it. And I'll come on and talk a little bit about that in the meantime. I'd just add that although these look like a relatively shallow recovery here so far, actually that's somewhere between 20 and 30%, depending on which region you've been invested, is the recovery that we've had from the low since the 23rd of March. Now, why is it that markets have recovered? And I think this is one of the big reasons. I've probably mentioned it quite a few times already, and it is the amount of extraordinary central bank stimulus that has come in. We're just building our own chart from here. So I stole this one from the Financial Times that came out the other day. But you can just see the incredible amount of asset purchases that have been going on now by the Federal Reserve, European Central Bank, Bank of Japan, and others, that is starting to flow into markets. And it dwarfs anything that we had after the financial crisis. And we believe that this is one of the main reasons why you're starting to see markets rally. Why have they come in to do this? Well, ultimately because they were worried about the risks of that 1930s period that Richard talked about and the Great Depression. The policy mistakes that were made, that there was no support that was made in the 1930s, and the central bankers around the world today are acutely aware of those mistakes, which is why they have come in with what our fixed income team would describe as shock and awe tactics. So what has that meant? Well, it's driven down bond yields. So this is in America, and you can see that over time we've been drifting from the early 2000s from 6 to 7% bond yields all the way down to the 30-year bond yield now being below 2%, and the 10-year bond yield being around just over 1%. So that's an extraordinary fall, and you can see it. The most recent one that we've had here is in 2019, as those interest rates have been cut. So interest rates being cut to zero, bond yields falling dramatically as a result, and being supported by those central bank purchases. And that has also meant that we've had a mitigation of some of the volatility that we had in the markets too. So that central bank buying that has supported markets has dropped equity market volatility on the left-hand side, but has also importantly mitigated bond market volatility on the right-hand side. So we had a week in March when I think at one period gold was selling off, US government bonds were selling off, UK government bonds were selling off, and equities were all selling off. And the only safe haven at that time was dollar cash. And that was clearly an indication that the financial markets were in stress. And that is when it was immediately after that, and then very quickly and quite impressively, the central banks stepped in to support the markets. So if that's ultimately what's fed into markets, you've had a repression. So we've had lots of money that's been printed that's gone into the government bond markets, that's going into the corporate bond markets, and ultimately flowing into the equity markets as a result. It has also underpinned some of the trends that has been going on in the previous years. And I'm just showing you the different regional equity markets here. And you can see that the US equity markets since 2008 in sterling have really been extraordinary in comparison to the rest of the world. Fortunately for us at Saracen, we're pretty global in the way we approach our equity investments, so our clients have benefited from that. But it's also something that's been reinforced during the crisis. And I think there are a couple of reasons for that. And that's because the US has a disproportionate number of information technology, consumer discretionary, and healthcare companies. So again, this chart is over the same period, and you can see that these types of businesses have been doing extraordinarily well, whereas the materials, your miners, your financials, and your energy companies have been doing quite poorly. Now, if we draw the chart since the start of 2019, on the right-hand side, you can see that that has just been reinforced. So actually, you've got healthcare companies, technology companies, and some utilities and consumer staples still generating positive returns over the last 15 months or so. But right down here at the bottom are the energy, financials, industrial companies. So there's been quite a really big divergence in terms of stock selection. And this is probably also reflective of dividends. Traditionally, you know, this area of the market, your energy, your financials, and your industrials have been quite big dividend payers. So for investors that like to receive their dividend income, it has meant that they might have foregone some capital appreciation. And the challenge is going to be going forward, how do we mitigate some of the dividend cuts that are coming from those sectors? And that brings me on to this chart. So as you know, this being particularly orientated towards charities, this talk, where income, as we know, makes up a significant proportion of what charities spend on a year-over-year basis. We've tried to put in here some estimates as to what we think markets will be cutting in terms of their dividends. So at the US level here, you can see we think dividends are going to be cut by a little under 25%. And then Europe and the UK, perhaps reflecting that exposure to some of those more traditional industries, dividends are going to fall even further, such that total dividends in the equity world are probably going to fall by about 30% over that period. Now, I know some of you that may well be invested in our endowments fund. We're fortunate that we've been able to accumulate an income and reserve over the last number of years such that we're able to maintain our income. And I'd also add that I think our thematic stock selection has enabled us to be out of a lot of these particular stressed industries. That means that some of our equity income is probably not going to be falling nearly as much as the markets. And at the moment, I think, for example, our global dividend and our global higher dividend fund are forecasting cuts in their income from anywhere between sort of 10 or 15%, although clearly things are moving quite quickly on the ground in terms of how companies are announcing. So how is that feeding into some of our stock selection? Well, what I've just put on here is the mega themes that we've got. So in terms of digitalization, and the next piece of work that's following from the stress testing is, are any of these themes and the companies that are in these themes either reinforced because of the crisis that we're going through, or are they more vulnerable? And just to take those more vulnerable ones, I think at the bottom here, the travel and experiences sector. So whilst we didn't have any airlines, we did have some hotels. We had Samsonite as well, although we've sold that within our multi-asset funds. And I think that there's definitely going to be a reluctance maybe to return to the travel and experiences that might have been driving some businesses. We'd also add that maybe even in climate change, low carbon transport, the fall in the oil price that we've seen probably makes that more challenging to swap your diesel car for your electric car, given that filling up at the petrol station is probably going to be a little cheaper. But then on the flip side of the positive sides, so on the left here is the digitalization theme that we have. And unlike today, where we have, I think, over 90 people listening to us today, undoubtedly there's going to be changes in the way we work, the way we shop, the way we consume, and a lot of that is being reinforced within digitalization. And I think that's what you're seeing going on in the markets at the moment. And then finally, just before I come on to sort of summarize asset allocation views, is also our ES&G analysis. And I think the focus at the moment, and you can see some of the things that we've been producing either on our website or on LinkedIn feeds and so on, is the social element here. And this is where we're trying to engage with businesses to make sure that they are looking after their employees, their suppliers, and making sure that they're sustainable and that they're ready to go back to work in as fit a position as possible. So drawing it all together before we come back to some of the questions, how have we been positioned? Well, we've been pretty neutral in our fixed income. So we had been adding to government bonds during the crisis, and then after we had the central banks come in and say that they were going to start buying corporate bonds themselves, we'd also went neutral in terms of our corporate bonds. Our equities, as Richard has alluded to, had got to a reasonable underweight position, but as some of our portfolio insurance positions has matured and markets have rallied, some of those have drifted a little bit higher today. And then within alternatives and cash, we've had overweight positions, overweight in alternatives, particularly within gold and our uncorrelated fund, trying to take advantage of some price dislocation in some infrastructure assets and things like that, but preferring to take risk elsewhere, and then also having some cash ready to take opportunities as they arise, but also to acknowledge the huge amount of uncertainty that's going on. And on that note, I would just finish with this slide, because I think this is perhaps one of the most important slides that we have in terms of our trustee training. And as Richard has alluded to, some of the best protection that you can have is thinking about time horizons in terms of your spending of your money. So we have here the short-term time horizon, medium-term and long-term, so that you can ultimately take the right risks with the right pot of money. And going back to Dominic's question, given the recovery in asset prices, I think if you need to take money from the long-term portfolio today, then it wouldn't necessarily be a bad thing.
James, brilliant. Well done. Thank you very much. Now we've got quite a lot of questions.
I saw them coming.
So I've got the first one's covered. So no, several people have asked the question about how is this all going to impact income. That's just a slide of where our endowments fund, and this is true would be true of any segregated portfolios with broadly speaking, 70% in equities, about 15% in bonds, perhaps 5 in property, and 5 to 10 in alternatives. This is the sort of makeup of income in the run up to the crisis. So if you've got about 70% in equities, you would expect probably about 60% of income to be generated. And a portfolio like that, broadly managed by ourselves, the modelling, and this goes back into the stress testing with the analysts looking into all the individual dividend and profit forecasts going out to 22, 23. We think that a fully segregated portfolio would probably be looking at a cut in income 19 to 20 of about 20%. Followed by a rise of perhaps 4 or 5% in 21, 6, 7% in 22. So that if you're running a big segregated portfolio, that's what you would probably expect to see. We do think that that will be better than a lot of people because of our skew to overseas, because the worst dividend cuts are going to be seen in the UK. And of course, with slight sterling weakness, we also benefit from overseas dividends in foreign currencies. Now, specifically, 2 people were asking about the CAIF, the big endowments CAIF. Well, here, of course, we do have another trick up our sleeve, which is in the good times, we do not pay out all the income we earn. If we get big special dividends, if we get large amounts of option income, we manage a reserve. And you can see that we went into the crisis with just over a third of a full year's distribution held back. So what our modelling suggests is that the big endowments fund, we will hold income in 2020 at 2019 levels. And actually that won't completely erase the reserve. We will be doing an awful lot of mitigating active management things within the portfolio. We've mentioned portfolio insurance. So we use options in 2 different ways. When markets are strong and rising and have reached high levels, and critically volatility is very low, we will opportunistically put in a bit of portfolio insurance. So we covered about 3% of the portfolio at the back end of last year. That was beneficial as markets fell. Of course, volatility has now risen substantially. That makes portfolio insurance very expensive. It's hard to take it out at these levels. We let it run off, as James said. But of course, with volatility high, what we now use options for is for writing puts and calls over single individual equity positions. And in the past, during periods of volatility, that's actually allowed us to increase our income by as much as 10 to 15%. So we've gone from a position back end of last year where we had no single puts and calls, and now we've got about 10 or 12 of them. So that, together with just hopefully good stock selection, we're probably looking, as I say, so we'll hold the distribution on the CAIF this year. In 21, it will either be flat or we might see perhaps a 5 to 10% cut. And then by 2022, certainly if we cut a little bit in 21, we'll probably be rising or growing again. But the best case scenario is it's flat for 3 years, which in the context of what's going to be going on in the wider marketplace will hopefully be a good result. And if nothing else, using the reserve this year will allow charities to plan at least 12 months ahead for any possible fall in investment income. Another question that came up, Dominic, you were asking a question about our response to COVID-19, what we were seeing companies doing, whether they were sort of behaving well and responsibly, the social contract. So one of the things we have been doing with all our investee companies is making sure that they are behaving well. So providing paid leave where necessary, prioritizing health and safety, maintaining employment where possible, trying to maintain supplier-customer relationships, financial prudence. So it's not for us to tell people how to do it, but we are trying to lean on companies to behave as responsibly as possible. But we must acknowledge that there are some very, very different circumstances out there. At one extreme, I know of institutions who've already had 85% of their staff furloughed for 4 or 5 weeks and are planning to cut their staff back by 50% on a permanent redundancy program because they've just said their business model over the next 2 to 3 years has been cut off at the knees, and to maintain any chance of surviving the crisis, they'll have to take actions of that magnitude. In other areas, we're seeing companies actually report that they're coming out of this strongly. They've not furloughed anybody, they don't intend to, and they don't intend to make any redundancies. If anything, they'll be looking to employ more people. So I think we're seeing very, very varied impacts that COVID is having on both companies, but also very different impacts on the charities we work with.
Richard,
Yeah.
I was just going to add, there was one other question about dividends. You know, what do we talk to our companies about paying dividends relative to the support for their staff or pension deficits and things like that? And I think it's a very difficult moral question to answer, because ultimately the dividends that companies pay feed back into people's pension portfolios or charitable portfolios. So I think the way we're treating that question is to take each company's situation very specifically and have discussions with management as to what's going to be the most appropriate for them. We don't want necessarily companies just cutting dividends just because it's a good opportunity to rebase things. But equally, we don't want to be, you know, it's a difficult thing where, you know, they might be paying out dividends to the detriment of their employees, and it's about getting the right balance. But I think it is just very difficult to say that there's one rule for everybody, and we have to look at companies in particular and their own specific situations.
Yeah, I think it's about sharing the pain and appropriateness. You know, that there are those out there who feel that equities are only owned by fat cats and shouldn't get any dividends. But we all know that actually equities are the lifeblood of charity investments, pension fund investments, life assurance investments. One of the things we do think, particularly in America, that this might well result in, particularly if people have taken any government payments, is potentially many fewer share buybacks. So a lot of the money that has gone into buying back shares over and above paying dividends, or instead of paying dividends, that is probably an area where we will see much less of that. Richard, there was a question from Richard about seeking out multi-asset portfolios without bonds, and actually several other questions about sort of inflation, deflation. Where do we see that going? In effect, and James has said this, we just don't see this in the short to medium term, but quite frankly, within our sort of investment time horizon for making changes to portfolios, as being anything other than deflationary. We're definitely not saying that this couldn't become inflationary, given the amount of debt in the system and the desire to make that worth less. But at the moment, despite the very low yields on government bonds, we still think they have a place to play in portfolios. And we think most of what has gone on is deflationary rather than inflationary. I'm aware of a few charity funds out that don't own any bonds or own very, very little bonds, but typically the ones that have very little invested in bonds have very substantial cash holdings, which would, if not be hurt in price terms, would not perform well in an inflationary environment. So I'm not saying that we won't at some point want to move substantial money out of government bonds, but for us, it's not quite now.
I think the only thing I'd add to that, Richard, is if you are worried about inflation and owning whilst we don't see that as a sort of short to medium term risk at the moment, you know, your only real option is to probably embrace more risk by owning more real assets in equities and property. You know, that's something that we have portfolios that we do here at Saracen, though not necessarily within our core funds that have been perhaps a little bit more balanced than that.
Yeah. Which and then there was a question from Peter about, you know, the element to which the re-rating we've seen has been liquidity QE driven. You know, and are we seeing a permanent re-rating of equities? Well, I'm not sure I'd want to use the word permanent, but there is a feeling that the attraction of equities relative to other asset classes, and particularly bonds and cash, given the virtually zero yields on those asset classes, even after the dividend cut, that the income we're going to be generating from equities will be certainly more than government bonds and cash, and comparable or more than corporate bonds. So we have seen a re-rating. That is the peculiar thing about this bear market, unless we see another big leg down. And we do think quite possibly the attractions of equities, and in particular growth equities, will be strong, and that the re-rating upwards we've seen is probably here to stay for the time being, if not forever. And I think, again, James touched on the thematic approach, but whether it's a thematic approach or just a real awareness of sectors, that there are sectors that we think are in pretty permanent decline. This is something we've been saying to clients for a number of years now, that there will be sectors that look cheap, but they're just going to get cheaper still, because their business models in the new world order are either defunct or will be shortly. So I think what's helped us in the last 6 months, 3 years, has been a focus on companies that are going to be the winners, and not just still exist, but be substantially bigger in 3 and 5 years' time. And possibly, if anything, COVID has brought the focus on that to be rather sooner than later. And a lot of companies, the old companies, for example, which we're almost completely out of, that they might rebound, but we just think the long-term growth prospects for that and a few other sectors are really very severely diminished, and their end is possibly brought forward by all the things we've learned to do over the past month or so. James, I've sort of got a list of questions I can work through, but there are any others you want to cover?
Well, there was the only thing I'd add to that is we talked about it at our virtual seminars, is the digitalization fund that we're going to be launching later in the year. That was something that we'd had in the pipeline, but everyone will probably see a little bit more about that when it launches later this year. The only thing, there's one other question on whether interest rates are going to go negative.
Yep.
I think that it's unlikely that interest rates will go further negative. So Europe, Japan, Switzerland, I think that they're there already. I find it hard to see how America and the UK will get there, because we've learned that actually negative interest rates can be quite harmful, particularly for the banking system. So that's perhaps why you haven't seen many more further negative moves from Europe and Japan, and just more central bank easing. So I think at the moment that's not the case. That doesn't mean to say that our bond yields might not get down there. We got pretty close in the depths of March in terms of our 10-year bond yield, but we might be able to test zero again if something worse, well, not worse, or if markets decide that the situation's worse than they can already see.
I'm just going through the other questions asked. There was a question about just turnover. I talked about taking mitigating action in the portfolios. It hasn't driven a huge amount of turnover. We're looking at basically sort of 3-4 stocks that we've chosen to sell, a couple because we do think their prospects have changed substantially, and a couple simply because the valuations, they've performed extraordinarily well through the crisis, and they do now on our new forecast look expensive. And we've topped up and added a couple of companies that we think will fare better from here. So, we're talking 3-4 stocks in and 3-4 stocks out on a portfolio that's about sort of 85-90 stocks long. And the other thing I've already mentioned, Dominic, was the options. That's really the area that if you looked at the portfolio 3 months ago and you looked at it today, there was a dearth of single stock options, and now I think we've got 9-10 lines, which, as I say, I think will generate 10 to 15% of our income this year through that. And if volatility remains high, we'll continue to do it. But if volatility drops away, the payoff won't be enough, and we'll go back to not doing it. There was a question about planning for an unstructured exit from the EU. I think most of us had got thoroughly bored in the run-up to coronavirus, that the news was so Brexit biased. Now you don't hear about Brexit, it's just COVID-19. I'm sure attention will begin to turn to our exit from the EU. We still think there will be some form of managed exit. But quite frankly, at the moment, we have been fully focused on fighting today's battles over the past month or so. As things calm down, the focus will absolutely turn to the EU. We did at the beginning of the year, somewhat fortuitously, for virtually all our clients, we took the sterling weight down by about 10 percentage points. So that's been mildly beneficial. James, I don't know if you want to say anything. I think that's really sort of the next thing we need to line up and get fully prepared for. But COVID-19.
Yeah, I think it's gonna come, isn't it? The second half of the year. You already sort of seen a little bit of it, even since Boris has come back from his recovery. That he's been starting to ratchet up a little bit and not wanting to extend the deadline and so on. So it will come back. I think today we have a little under 20% in UK equities, which are quite international. As Richard alluded to, the sterling level is lower. So on an absolute basis, I'd expect that portfolios are reasonably well positioned for whatever outcome we get. And as always, it will be quite unpredictable given the political environment that's going on. Did you have anything else, Richard?
No, I think I've grouped a few of the questions together, but that basically is it. And we're up to our sort of hour or so. So I think we should probably draw this to an end and let everybody go back to their day jobs and peace and quiet of their homes. So I think unless anybody else has anything to say, and I can't see any waving hands or more messages coming in, really just from James and myself and the team at Saracen. Thank you very much for listening today, and really thank you very much for your continued support. The slides will be made available later on to everybody who was here. We can send those to you. And of course, please do, if there are any questions you would like to ask of your management team at Saracen & Partners, do get in touch. We've found this Zoom process, both for client meetings and small webinars like this, really useful. So please, we're here to respond to your calls. Do get in touch. So on that note, goodbye from me, goodbye from James.
Goodbye.
And I will sign everybody off. Thank you so much.